Welcome to lesson 2 part 2, where we continue to learn about the basics of the stock market. I'm your teacher and mentor, Mntom'nyama. In this video, we are going to talk about the price to earnings ratio, also called the PE ratio. This ratio is used to value companies, specifically to determine whether they are fairly priced, undervalued, or overvalued. It is the quickest and most simple way to value a business. We calculate this ratio by dividing the share price of a stock with the company's earnings per share. So the equation, as you can see, it's PE ratio is equals to the share price of the stock divided by the earnings per share of the stock. Okay, so let's look at one example. Let's calculate the PE ratio of Microsoft. We will need the share price and we will need the earnings per share. Where do we get this information? We go to our FinViz website where we'll get the information for Microsoft. So we go to our web browser. We type in FinViz MSFT, which is the ticker symbol for Microsoft. And we click on the link, which will take us directly to the FinViz website where all the information we need for Microsoft is displayed. And as you can see, the share price for Microsoft is currently sitting at $376.04 per share. And that's the figure we are going to use in our equation. And the earnings per share, you can read it off here, it's 10.33. So we take these two figures, we plug them in our equation, and we get 36.4 times. Now, what does this figure mean, this 36.4 times? What does it mean? This means that for every $1 that Microsoft earns in profits, an investor will have to pay $36 for each share. In other words, Microsoft is selling at 36 times its earnings. But fortunately, we do not have to calculate this figure either because it is already given to us. So when we go to the FinViz website again, we can see that the PE ratio of Microsoft is 36.42, which is exactly what we got. So you don't have to calculate it. It's already given to you, but it's always good to know how it's calculated. So now the next question would be, at 36 times its earnings, is the Microsoft share cheap or expensive? Well, many investors will say that Microsoft is very expensive at 36 times its earnings. They base this over an old and generalized characterization of the PE ratio as shown on this chart. Conventional wisdom used to say, when the PE ratio of a stock is between 0 and 10, then that stock is undervalued. And when the PE ratio is 10 to 20, that share is fairly priced. This is at fair value. But when the PE ratio of the stock is greater than 20, then that share is considered to be expensive. Now, this approach is too general and does not take into consideration some important aspects, and hence used on its own, the PE ratio could be very misleading and it can give very misleading results. Therefore, let me show you why I am saying that the PE ratio, when it is used on its own, could be very misleading. Let's look at an example. Let's consider that we have two companies. We have company Piwe and then we have company Lwat. Both companies have a net income of $100 million. But the shares outstanding for company Piwe is 100 million and that of company Lwat is 10 million. Also, the earnings per share for company Piwe is $1 per share, whereas the earnings per share for company Lwat is $10 per share. Given a choice to buy a share of either company Piwe or company Lwat, which share would you buy? Which share is worth more? You got it right. Company Lwat share is more valuable than company Piwe share. Why? Because each share of company Lwat generates $10 in profit, whereas each share of company Piwe generates only $1 per share. So you got it right. Company Lwati share is more valuable. And this reinforces what we learned in part 1 of lesson 2, that the company with less shares tends to be more valuable. We said that we want companies with less shares because we get to share the profits of the business with less people. Our piece of the pie is much bigger when the shares are lower. Don't forget that. Now, let's look at another scenario. Let's assume that the share price of company Piwe is $10 per share, whereas for company Lwati, the share price is $50 per share. Now, looking at these two now, which is cheaper? Is it company Piwe or company Lwati? You got it right. Company Lwati is cheaper than the share of company Piwe. But then you will say, wait, Mzamo, wait a minute. Piwe shares are $10 per share compared to Lwati's shares, which are $50 per share. How can then company Lwati share be cheaper at $50? Basically 5 times the share price of company Piwe. Remember, for company Piwe, we paid $10 to buy 1 share, and we receive $1 in profits for each share per annum. So if the earnings don't grow, how long will it take you to get your money back? How long will it take you to get your $10 back? You got it right. It will take you 10 years because every year you get $1 per share. So it takes 10 years for you to get your money back. Compare that with company P. You paid $50 for that 1 share that you bought, and that share is earning you $10 every year. So how long will it take you to get your $50 back? Yes, it will take you 5 years. It takes you less years, and therefore the share of company Lwati is cheaper than the share of company Piwe. And that, ladies and gentlemen, is the concept of the PE ratio. You can see that company Piwe is 10 times and company Lwati is lower at 5 times. So it takes you less time to get your money back. And that is why when people are looking at this figure, they will deduce that company Lwati shares are cheaper because they have a lower PE ratio. And this is, in this instance, generally and consistently correct. So this gives us a very good lesson in that you cannot tell whether a stock is cheaper or expensive merely by looking at the share price. If you were just looking at the share price only, you would be deceived. You would think that company Piwe is less expensive. But the PE ratio says otherwise. It is company Lwati that is cheaper because it takes you less years to get your money back. So I hope you guys get that. So in general, do not make the mistake of avoiding a stock just because it has a high share price. Great companies tend to sell at a higher share price, but that doesn't mean that they are expensive. Mediocre companies will also tend to have lower share price, but it does not mean that they are cheap either. It all depends on the earnings of the business. Okay, so let's throw another spanner in the works. Let's assume that company Piwe, its earnings per share is growing at 100%. In other words, the earnings per share doubled every year. And that of company Lwati, the earnings per share growth rate is 0. In other words, the earnings per share do not grow, they remain at $10 per share. Considering this scenario now, which share is cheaper? It is still Lwati, or is it now company Piwe that has got a cheaper share? You got it right. Because of the earnings growth rate of 100%, company PE share is now cheaper than the share of company Lwati, which is not growing at all. Let me show you why I say this. Okay, if you're looking at company PE, in year one, the earnings per share is $1 per share, right? In year two, the earnings per share will double up and will become $2 per share. In year three, the earnings per share will double to $4 per share. So you have 4 plus 2 plus 1, we have $7 which you have accumulated so far. And then in year four, the earnings per share will double from $4 per share to $8 per share. So this is an accumulation of $15 per share. So roughly, it will take you approximately 3.5 years to make your $10 back. Whereas before the 100% growth rate, it took you 10 years, but because of the higher growth rate, you now recovering your money quicker. That is why it makes the share of company PE less expensive and more valuable. Looking at company Lwati, which we said is not growing. So every year, the share, the earnings per share will be $10. And then how long will it take you to get your $50 that you paid for that share? It will take you 5 years. So now, because of the higher growth rate, company PE, you get your money back in roughly 3.5 years, compared to company Lwati, which still takes 5 years for you to get your money back. And that is why, because of the high growth rate, company PE is now more valuable. And the lesson we learn here is this: the stock with a higher PE could be cheaper than the stock with a lower PE, as in this example. It all depends on the earnings growth rate. And this is the mistake that many investors make. They think that a stock with a higher PE is expensive and a stock with a lower PE is cheaper. And as I have shown you in this example, that is not always the case. The PE ratio by itself will be misleading most of the time. That is why you have to use it in relationship with the earnings growth rate. In other words, a stock with a higher PE could be cheaper because of the high growth rate. Usually stocks have a low PE because they have no growth. That is why the company keeps going down. Whereas normally companies with a high PE ratio keep going up and doing well because they have a higher growth rate. And so I repeat, you cannot look at the PE ratio in isolation. It has to be used in relationship with the earnings per share growth rate. And this brings us to another important ratio that we must talk about, called the PEG ratio. This is the ratio that takes the PE ratio and relates it to the earnings growth rate. It was made by Peter Lynch, who is a legendary hedge fund manager who developed this PEG ratio. So in theory, he says that the PE ratio should be equal to the earnings growth rate, as you see from this equation. PE ratio should be equal to the earnings growth rate. So if the PE ratio is at 30%, if the earnings growth rate is at 30%, then the PE ratio must be 30 times. If the earnings growth rate is at 10%, then the PE ratio should be 10 times. Okay? And this is used to develop the PEG ratio, which is calculated by dividing the PE ratio with the earnings growth rate. Now, there are 3 scenarios that you must consider when using the PEG ratio. Number 1, in theory, if the PEG ratio is equals to 1, then the stock is considered to be selling at fair value. If the PEG ratio is greater than 1, then the stock is considered to be expensive. If the PEG ratio is less than 1, then the stock is considered to be cheap. Okay, I hope you guys get that. So let's make an example. Let's calculate the PEG ratio of Microsoft. We already have the PE ratio of 36 times earnings that we calculated earlier. Now let's find out what the earnings per share growth rate is for Microsoft. Where do we get this figure? We go to our FinViz website and we read off the expected growth rate of Microsoft for the next 5 years. And the EPS next 5 years is 15.42%. So Microsoft is expected to grow by 15.42% per annum in the next 5 years. So this is the figure that we will use in our equation. We plug these figures in our equation and we get 2.3. So theoretically, Microsoft is currently expensive if you consider that it is selling at a PEG ratio of greater than 1. All right? I hope you guys got that. Now, it is very important to know that before you start using the PE and the PEG ratios to determine whether a stock is expensive or not, even though these methods are very simple and are quick, these methods have a lot of limitations and can sometimes give misleading results. Let's have a look at the 2 key limitations of the PE and PEG ratios. Number 1, the PE ratio on its own can be misleading because it does not take earnings growth rates of a stock into consideration, as I have shown you in the previous slides. Number 2, sometimes the profits of a business may not reflect the true earning power of the company due to some short-term distortion of earnings. This could be due to high but temporary expenses or income. All right. Let me use an example for Amazon so that you guys can get what I'm saying. Let's have a look at the PE ratio of Amazon. Again, we go to our Finviz website and we go to Amazon. And you can see it's Amazon. And then we scroll down, we read off the PE ratio of Amazon, which is 79.33, which is basically 80 times. So the PE ratio of Amazon is currently sitting at 80 times. Now, at 80 times earnings, people would say that Amazon is very expensive. But if you actually study the business using a more comprehensive valuation method, which we will learn in later lessons, you will find that Amazon is not so expensive. If you take a closer look, you will find that the earnings are temporarily distorted down. Why? Because Amazon is making a lot of money, but in the last 2 to 3 years, they have been spending huge amounts of their profits into research and development and into building their infrastructure. They are doing this in order to dominate the market, increase their market share. So with all this spending on infrastructure and research and development, the earnings have been temporarily distorted down. And when the earnings per share get distorted down, what happens to the PE ratio? It shoots up, it gets inflated up. All right. As you can see from these graphs, they demonstrate the same thing that I've been using. This is the cash flow, operating cash flow for Amazon. And you can see that it's been going up and it's still up, although there is a slight dip in the cash flow that happened during the COVID-19 lockdowns. But you can see that they are still generating a lot of cash. But what's happening is they are taking that cash and they are using it on research and development in order to develop new products and services. They are using those profits, that cash, on building their infrastructure because they have a plan of taking over the whole world, basically. So because of that short-term expenditure, what has happened to the earnings per share? The earnings per share have shot down. They are very, very low. As you can see from this equation, when the earnings per share go down, what happened to the PE ratio? The PE ratio gets distorted and it gets inflated up. So that's why you see a PE ratio of 80 times earnings, because of this temporary distortion of earnings per share, which I've just explained to you. But I expect that once the spending on infrastructure and research and development has been concluded, you will find that the PE ratio of Microsoft will go back to normal levels. And you will see that Amazon is actually selling at a discount or at below its intrinsic value. All right, not so expensive. but I expect that to happen in the next year to 2 years. Okay, so in summary, people like to use the PE and the PEG ratios to value stocks because these methods are simple and quick, but they have a lot of limitations and hence unreliable for the reasons which I've just mentioned to you guys. So in the meantime, use the PE and the PEG ratios as an initial step to your valuation process, but take the results that you get as information only. Do not base your investing decisions on the results that you get.